Okay, so welcome to this video and section that it's going to be talking about the ethics module for our LOQP license. As you are aware, um, this ethics module, it could be studied if you want to take the LOQP exam in any province except Quebec. So in Quebec, there are some differences. Maybe 70% of the information is the same. But again, there's about 30% difference. So for those who are seeking to get their license in Quebec, I recommend that you figure out what the differences are or look into other resources for education. But overall, for other provinces, this would definitely help. So, I mean, like, honestly, it's really obvious. Just be ethical. This is exactly what this module is about. And it's about ethics and, an ethical work and an ethical behavior when you are, working as an insurance advisor, and what are the do's and don'ts that you must be following, right? Now, when I say that just be ethical, honestly, it's really as simple as that. A lot of questions, you just have to make sure what is the most appropriate and the most ethical answer. That's it. Honestly, there's nothing more to it. And just like any other module, I will be covering 80% or more of the information, and that will definitely help you with passing all the exams. So I know for those who watched our, understanding insurance module, we have explained this slide completely. And I don't want to go over with it again because obviously it's going to be just reluctant. So if you haven't studied or watched our understanding insurance video, please go watch that one first and then come back and study the ethics and watch this video. All right. And the reason is that we have, breaking down all these parts, which is really important regarding what is the process of getting insurance. Now, today, we're going to be talking about what are the ethical parts in this, basically process. So first of all, again, really important. Who is the one that is filling the application? It's the client. The agent can only help. And all the questions must be answered by the client. All right. Another thing that's really important. When there are requirements that needs to be signed, the client has to sign them. There might be a question that it tells like, oh, there was one signature left and they forgot to sign it. And the client tells the agent, well, you just sign on my behalf. That is wrong. We cannot do that. So be careful. I'm giving you guys hints about all the different, questions that might come up. Submitting the application is with the agent. So this is where the agent comes in place and they submit all the applications and all the requirements that are needed, and it goes into the insurer, right? Let's talk a little bit about TIA here. So temporary insurance agreement. Make sure that the client does not want to leave North America in the next basically 3 months. They have to pay their first premium, answer no to certain medical underwriting questions. This whole TIA is valid for 3 months. So after 3 months, if they pass away and there's still not a decision made for their insurance, they are not covered anymore. It must be over 18 to get this. So there might be a question, and it asks that, okay, John is going on vacation next week, and right now is filling out the application form with you guys for, the insurance. What do you suggest? You suggest that you do not submit the application, pause everything until they come back from their vacation. Why? Because maybe the vacation is outside of North America. Let's say if they're going to London, or they are going to the United States, but it's going to be more than 2 weeks. So that's the other question. Are you going to be leaving are you going to be leaving Canada and staying in United States or Mexico for more than 2 weeks? Again, it won't cover. So it's only going to cover for 2 weeks. So this is really important. Again, really important. When is a policy um, in force, basically? It is when the delivery signature has been done and also the first payment has been paid. So in terms of the cancellation rights, you have to be careful. Let's say if it was January 10 that they got approved and the client signed the application on January 11 and also designated the first premium to be on January 15. So the time and the date that the policy is going to be in force, it's going to be January 15. So if they die in January 14, they didn't have insurance. Let's say if the client applied for TIA when they were submitting the application. So they've already paid the first premium. So now in January 11, when they signed the policy is automatically in force. So now if they would have died in January 14, they would have got, basically the death benefit. So this is really important. If there was no TIA, make sure that you know that the enforced date is from the date that the policy was signed, the delivery, and also the premium was paid. But if there was a TIA, since they've already paid the first premium, obviously from the date that the policy is signed, the delivery signature, um, you are able to say that it's in force. Let's say the agent goes to capture the signature, right? The delivery signature, and they see a difference and a change in the client's health. For instance, coughing a lot. Ask what's going on. The client says, yeah, I went to the doctor, I went to the hospital, I wasn't feeling well. They're giving me a couple of medication, and we're waiting for further investigation or tests or whatever. All right. What does the agent do? You do not deliver in this case. You do not deliver, and you will go back to the insurance company. You will write a note. It is in the delivery section as well. If there's any, comments for the insurance advisor, you'll write down this is a situation. There has been a change in the medical condition of the client. Please advise what to do. It's the insurance um, right to make a decision what they want to do, not the insurance advisor. So the insurance company will make a decision. Our job is just to inform. Our job is just to inform. We cannot decide if this is a critical condition, if it's not a critical condition, what the hell it is. All right. So you do not deliver. Let's say financially there has been a change. They lost their job. You don't deliver, right? Or let's say the client in the application said that I'm a non-smoker, but when you go to deliver the policy, you see there's a pack of cigarettes in their pockets, whatever, right? Or they said that I'm not an alcoholic, but it's 12 p.m. in the afternoon, and you see that they smell drunk or whatever. Again, you will not deliver. But let's say if they just caught a cold, right? Client says, yeah, I mean, I got caught a cold and I'm just resting a little bit. And the doctor said it's nothing. It's just, I'm taking, cold medicine and that's it. Then you are able to deliver it. It's no problem. So as long as it's not, uh, a health concern or a pending investigation or something like that, we're good. If it's a fracture, again, you don't deliver. So I'm just giving different scenarios. If it's a promotion in their job, you deliver. It's okay because their financial situation has actually became better. But if they've lost their job, even though that they say it's no problem, I'm going to find a new job right away, I actually have an offer and blah, 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 you still will not deliver. Okay. So these are really important to focus on. Um, so underwriting, we've talked about it in the understanding insurance. Policy owner, again, remember if there's an assignment, the beneficiary is waived, right? So the beneficiary will become the insured um, estate. We've talked about all of these. So I'm just going into the ethical parts right now in this slide. But just, obviously, again, review that video, which is going to help you a lot. Um, I don't see anything else that we need to talk about. Just remember that if you are licensed in Ontario and you want to do business in BC, you have to register your license in BC. All right. So there's no extra exams or anything, but you have to do that. The only province that you will need to do an extra exam is Quebec, which you have to do the ethics exam again. All right. I think I've given the most important parts. Just remember again, all the information of the client, it has to be stored in a safe place that nobody else has access to. So it should be in a locked place. Just remember that as well. So let's go into a couple of questions. So this one, it's saying that Theodore owns a $1 million life insurance policy on the life of his wife, Aurora, and his daughter, Ophelia, is named as the beneficiary. Theodore dies unexpectedly without naming a successor policyholder. What happens to the life insurance policy? So obviously, Theodore is the policy owner, but the insured is the wife, and the wife is still alive. So there's no death benefit being paid out. So now the policy owner has died, and we need a new policy owner. And because there was no successor for this, what's going to happen? They can't just say Aurora is going to be the, policyholder, or I don't know, the son is going to be, or the daughter is going to be the policyholder, because we don't know what is the mental capacity of Aurora. Maybe, she's in a coma. We don't know, right? So obviously it's going to go like any other assets and ownerships that Theodore had. It's going to go to the estate, and then the estate is going to designate a new policy owner, just like when they want to, change the ownership for any other assets that Theodore had. Next question. Natalie owns a critical illness insurance policy, which she purchased 2 years ago. Her business faces heavy losses and she becomes bankrupt. During this time, she forgets to make the premium payments for her CI policy. Worried that her policy would have lapsed, she calls her agent for advice. In this case, the agent is likely to. So, when it's a critical illness policy, what happens is that if you receive the termination notice, um, you cannot do anything. If she hasn't received the termination notice, she can pay the premiums and prevent it from lapsing. Okay, so that's the most important thing. For critical illness, it's like that. For life insurance that doesn't have cash value, there's a 30-day grace period. Okay, so that's for life insurance. For CI, it's whenever you get the termination notice. Okay, and we're going to go further on and we're going to talk about disability as well. If there's a life insurance that has cash value, obviously the insurance company can take money out of the cash value. And this one, Jamal, a resident of Ontario, has two children, Vish, age 17, and Rain, age 18. Jamal is meeting with his insurance advisor to review the benefits of taking out a whole life insurance policy for his children. He wants the policies to be structured in a way that the children's own policies on their own lives and the benefits of each policy going to their siblings irrevocably. One policy would be on Vish, with the benefits payable to Rain, and vice versa. What signing authority will Vish have, if any? So this is how the situation is. We have a policy owner, we have the insured, and then we have the beneficiary. So for one, Vish is a policy owner, Vish is the insured, and Rain is the beneficiary. And then there's another one that Rain is a policy owner, Rain is the insured, and Vish is the beneficiary. And remember that the beneficiaries are irrevocable. All right, so this is important as well. Now, what can we do here? Because Vish is 17 and Rain is 18, as you know, for receiving the money as a beneficiary, you have to be 18 years or older. And because this is an irrevocable beneficiary, that means that the beneficiaries have a signing right as well. If there's any changes made to the policy, they have to have the beneficiary's consent. If it was a revocable policy, we didn't need any signing of, signing consents or stuff like that. So in this case, because Vish is still 17, so for Rain's policy, if there's going to be any changes, Vish cannot sign. But again, in law, the policy owner could be 16 years or older. So they already have the capacity and the eligibility to make a change and sign it for themselves. So right now, Vish only has authority on his own policy as a policy owner, but does not have authority or making any signatures, I would say signing authority for Rain's policy. So A is the right answer. Vice versa, if we look at Rain, because Rain is already 18, he both has the signing authority for his own policy and also signing authority for his brother's policy, which he is the irrevocable beneficiary. And this question is regarding accident and sickness insurance, right? Disability insurance. If there is such an insurance and they fail to pay the premiums, you have 10 days after you receive the cancellation, termination notice. So CI, critical illness, it's immediately when you get the termination notice. For disability insurance, it's 10 days after it was mailed. Okay, this is really important. And just another question, really easy. Brandon recently purchased a life insurance policy in which the death benefit decreases as he attains stated ages. What type of provision is this known as? So because the death benefit is decreasing, obviously it is called reduction. Exclusion means that there's an exclusion of the policy that they will not pay in certain circumstances. Deductible means, and it really doesn't work on death benefit, it works on critical illnesses or disability insurance, that you basically the first claim, a part of the first claim, you have to pay it on your own pocket. And limitation is basically regarding the waiting period and the time period of getting benefits in critical illness or disability insurance. And let's go to another question, really easy. Joanne makes a claim to get payment from her disability insurance after she loses her eyesight. Her claim gets rejected because she had some eye problems even before applying for the disability insurance. Which of the following exclusion is the reason Joanne's claim is rejected? Obviously, it is because of the pre-existing condition, right? And that is why it was declined. So that was just a review and kind of talking about the ethical parts and some regulations of insurance process. Now let's have a review on, some of the pensions and benefits that the government provides us, right? So when we talk about public insurance and retirement regimes, it's really important to understand that we have two different, governments. We have a federal government and we have a provincial government as well. So we have some benefits from the federal government. These four are a federal benefit or pension. CPP Canada Pension Plan, which working was a condition to receive these benefits, right? So you should have been contributing to your CPP when you were working. EI is employment insurance, which is when you are employed, you will get some certain benefits if you, get laid off or you become disabled, stuff like that. Old age security does not have any working, requirements, right? So you might have not even worked a single day in your life, but it is based on age. So for those who have studied segregated funds, obviously you know this. It's minimum 10 years, maximum if you have lived maximum for 40 years or more in Canada after age 18, you are eligible for the maximum amount of OAS, which is payable at age 65. To know and understand more about OAS, CPP, and all of that, please watch our segregated fund video, and we have a complete explanation on that. We're just reviewing over here. And GIS is a government income supplement, which is for people that they are really low income. So even though that they're getting their OAS, so a requirement of being eligible for GIS is that you are receiving OAS. And all your income and everything together is still not sufficient enough, and the government will give you an extra supplement as well. Now, it's really important to know that all these three, right? So CPP, EI, and OAS, they are taxable benefits. So you have to pay tax on the benefits that you receive, but GIS is tax free. All right. Again, we have explained all of these in the segregated fund video. Please watch that to get a full understanding of all the, basically terms and conditions of these benefits. Now, in the provincial side, we have no fault automobile benefit, right? We have a universal health. So like for Ontario, it's called OHIP, Ontario Health Insurance Program. And we also have something called workers' compensation, which again, maybe in different provinces, it has a different name. But basically what it does is that if you were working and get injured during work or in work-related, incidents, you will get benefits, right? Again, we have talked about all of these in the disability. So in the accident and sickness module, you can definitely learn more about this. And again, a universal health is not free and it's taxable. It's basically us paying tax and then getting these benefits. So the only benefit that we can receive and is tax-free again is workers' compensation. So this was just a really quick review about this because we will need it to answer our questions, but full information, you can find them in other modules. Let's talk about saving and investments, which again, in the SIG Fund video and module, you will learn more about it. We're just going to do a really quick review. So registered and non-registered accounts, I would say. So the registered accounts, basically most of the accounts, like all the accounts that they start with an R, are registered accounts, like RSP, RESP, RDSP, and also other, accounts like TFSA, LIF, LIRA. All of them have been explained in segregated funds module. So I'm not going to go too much into it. Just remember the TFSA, the growth of the investment is tax-free. RSP is tax deferred, right? RESP does not actually have any tax benefits. It's more about the grants that the government provides. And then we have LIF and LIRA as well. And then we have the non-registered accounts, which is basically any other account that is not with the government, right? You just get it from a financial institution, you put some investments in it, and that is what we call a non-registered account. Now, as you know, we can do different investments in any of these accounts, right? Either registered or non-registered. You can put stocks in it, you can put bonds in it, you can actually put funds in it, right? So what is the difference between a mutual fund and a segregated fund? The difference is right here. A mutual fund is when you purchase those funds through a bank, and a segregated fund is when you purchase it through insurance companies. And what is the major difference? It is that a segregated fund, because it is purchased through an insurance company, it would be credit protected, and also it has guarantees. What are the guarantees? Life guarantees, basically death guarantee, and also maturity date guarantee, which is 100% or 75% of the deposit, depending on what you choose. Again, all these information have been provided in segregated funds module, so please review that video if you have further questions. We have breaking it up down completely, but this was just a review. Let's go into a couple of questions just to understand more about how this works. So I don't know why I put this name because I don't know if it's Margie or Margie, but let's just call it Mary, actually. So Mary is a self-employed accountant who earns about $60,000 annually. She is reviewing her financial situation and worried about what would happen if she was unable to work through no fault of her own. She knows that there is a risk she may become disabled or not earn enough during the slow seasons for accountants. Her friend, oh my God, this is even much difficult. We'll just call her Anne. Anne is an accountant at a large company that lays staff off regularly, and Anne always applies for employment insurance between contracts. What should Mary be concerned about if she were not able to work? So see, there's two different types of people. We have Mary, who is self-employed, right, and earns about $60,000 annually. And then we have Anne, which is an employee that works for a large company, right? And because that company lays off staff regularly, um, she applies for employment insurance for EI, because that's one of the benefits that EI provides. But the issue is that EI is only for employment. Because Mary is self-employed, right, and haven't been contributing to any EI insurance, then what the answer should be is that she does not qualify for EI because she is self-employed. So that's really important. Let's go to another question. Bob retired 3 years ago and is now in need of income. He has a registered retirement savings plan, RSP, and a locked-in retirement account, LIRA. When he asks his advisor, Laura, for help, she tells him that he needs to open both a registered retirement income fund, RIF, and a life income fund, LIF. He asks Laura what the difference is between RIF and LIF. What will Laura tell him? I will just tell you guys, please memorize this. This is the right answer. LIF has both minimum and maximum withdrawal restrictions. So every year after retirement, you must take out a minimum amount, but you cannot take more than a certain amount as well. Whereas in an RRAF, we only have the minimum. So you must take out a minimum amount every year, but if you want, you can take 100% of the money as well. That's the biggest difference between LIF and RRAF, and it tends to come into the questions a lot. So please memorize this, just make it easier for you. All right, let's go a little bit more into ethics. I know till now it was a lot of review sessions about what life insurance is, a couple of parts about the benefits that we have and, investments, right? We just did a short review, and now we're going to talk, more about the ethics module itself, right? So what happens? And we're actually halfway through the module as well. So, it's not that difficult. When somebody dies, what happens? You guys all know. Well, they're dead, right? But on the other hand, is that all their assets and all their stuff that they owned is going to go into a piece of paper. It's going to be written down on a piece of paper called the estate. That estate is going to go into a court, which is called the probation court. What happens in the probation court? So the probation court is going to receive that estate with all the ownerships, all the assets, anything that that client basically owned and had. And then they're going to be calculating the liabilities and the debts. They're going to be calculating the taxes. How are they going to do that? They're going to assume that the deceased person sold everything the day before they died. So if you sell everything the day before you die, you have to pay all the taxes on the growth. And also you have to pay all the lenders or all the creditors that you owed money to. Then there's going to be a lawyer on behalf of the deceased. You have to pay that. There's going to be court fee. There's going to be probate fee as well. This probate fee is about 1.5% of the assets. So like approximately out of every $1 million of assets, the court is going to charge $15,000. Now, when all of these calculations are done, all right, let's say for instance, the estate had a value of $2 million. All right, so that's the amount of assets that the deceased person had. They calculated the liabilities, debts, the taxes, all the fees and everything. It turned out to be $800,000. So whenever the family pays off this $800,000, they're going to release this $2 million of assets. If the family does not have the money to pay off and pay this basically $800,000, that is when they're really going to sell the assets, and then the remaining is going to be given to the family. So when we talk about remaining, it means that there's going to be a probate letter, and this probate letter is going to be changing the ownership of the assets. All right. So this is really important. Once again, all the assets they will be listed on a piece of paper called the estate. It's going to go to the probate court. Probate court is going to calculate everything. They're going to ask for the money. If the money is not available by the family and the beneficiaries, then they're going to be selling whatever is left. They are going to be changing the ownership based on the probate letter. This is where a will come in place as well. So after all of those calculations and fees have been paid, then they're going to open the will and they're going to say, okay, let's see what the deceased person wanted to do, right? It is not before all these calculations, it's after all the calculations that have been made. So when we're studying ethics, right, there are a couple of, I would say, words and definitions that we have to know. And these are really important. So first of all, estate. The assets owned by a deceased is called an estate. Second, what does seize mean? It means that there was no creditor protection. Anything that a creditor can take as the money that basically the deceased person owed, it will be called a seizable asset, right? It means that the creditor can take it, so there's no creditor protection. Obviously, an unseized asset means that it has creditor protection and the lender or the, basically creditor cannot take that money. A testate means dying with a valid will, and intestate means dying without a valid will. So if there's any question and they say, yeah, this person had testate, that means that they had a valid will when they died, all right? And this is really important. Power of attorney, another thing that's really important. Who is a power of attorney? An attorney that is valid till you're mentally stable. So let's say if you have, a home and you want to rent it out, but, you live in another country. So you might give a power of attorney to a family member or to a friend that it makes them eligible to rent out that property. But they are not allowed to sell it. Okay. So they don't have full authority. They only have a portion of authority that the person has already given that, permission. And it's only valid until you are mentally stable or basically alive. So if you get dementia, if you go into a coma, whatever happens, that POA, power of attorney, is not valid anymore. All right. So it's when you are still alive and you are still, able to make decisions. But what is an intro vivos trust? So an intro vivos trust is a trust that is established during lifetime. This one, it's kind of like that person has full authority for that certain matter that you make in, your trustee. All right. So it's not like the power of attorney that is only for a specific part. A trustee could actually be entitled to everything. So they have, the rights to make different decisions. And then it's only when you are still alive. But if you put in a trustee for the time that you die, so they can take care of all these estate and the taxes and everything, right? And take care of all these debts, basically pay them off and all of that. That is what we call the testamentary trust. So it's a trustee that is established upon death. So while the person is alive, there is no trustee. The trustee does not have any authority. But when the person dies, now they become a trustee and they have, the rights and all of those, authorities as well. Okay, so that's the difference between inter vivos trust and testamentary trust. All right. What does it mean that an asset, right, is passed through estate? It means that it was considered to be in the estate, right? And the court will decide about what's going to happen about it. All right. So let's say if I have, company shares, okay, company shares. What's going to happen here? Sorry about my handwriting. Honestly, this is really bad. I'm just gonna rewrite it. I'm not that bad. So this company shares is going to go into the estate. So it's called pass-through estate. But if I have an asset that is not going to go into my estate, it's not going to go to the probation court. That is what is called a bypass of probate. It means that that asset will not go inside the estate. It will not go inside the probate. It's going to bypass it. Basically, the court will not make a decision about it. What are the main two assets that do not go to your estate, or basically they are a bypass of probate? It is the insurance death benefit, right? And also segregated funds benefit. So as we talked about it, segregated funds, they have creditor protection. That means that when you die, it does not go into the court. It directly goes to your beneficiary. Same thing with insurance death benefit. Obviously, you guys know, if you have, again, watch the understanding insurance video, we have talked about it, that there's preferred beneficiaries. There's different types of beneficiaries that some of them are entitled to this bypass of probate and some might not be. All right. So this is really important. So that is why that there's going to be no tax implications and there's going to be no deductions from creditors. So this is really important to understand. These are a couple of words and a couple of phrases that we need to understand. Okay. Now let's go into speaking about something really important, which is family. So you know what? There's always this controversy about what is a family asset or a family property and what is considered as a personal property. Do we have any personal property after marriage or do we not? Or what is the difference between marriage and common law in these circumstances? So let's first of all define and explain what is a family property. This is really important. So a family property refers to property that was acquired during the marriage, all right, or relationship, or is used or enjoyed by the family of married spouses, or that generates income that supports the family. So let's say if I get married and I purchase a home after marriage, that is considered a family property. If I have a personal property before marriage, but now my wife comes and lives in it, right? It's considered family property. Or even I have a cottage and the family uses it like once a month for going, to the cottage and, just, basically vacation. Or let's say I have a rental property, I'm renting it out, right? It's a personal property, I bought it before marriage, but the rent is supporting and generating income for the family. Again, that would be considered a family property. But if I have a property that my family is not using it, I bought it before marriage, and there's no income generated that's supporting the family, it is still considered a personal property, which is rare to happen, to be honest. And we're not talking about prenup right now. I know this comes into your mind. Well, we have prenup and prenup, blah, blah, blah. Right now, we're not talking about that. And even when we're talking about that, there's still some exclusions. Something else that's really important is that death benefit is a personal property, even after marriage. So let's say if someone's father or mother passes away and they were the beneficiary of that death benefit that they received from the death of their parents. Now, what happens is that uh, they will, basically, even because that money has been received after marriage, it is still considered a personal property, and it is not a family property. Okay, so that money is personal when it's about death benefits, or basically any gift that you receive, from your parents and all of that, it will be considered personal. So let's talk a little bit about the difference between marriage and common law. Marriage is a formal legal status that is acquired or terminated by the federal law. So it's not provincial. I can't be married in Ontario and be single in BC or in Saskatchewan. So obviously it's a federal law and it could only be acquired or terminated by the federal government. Common law is a form of couples that are living together for more than 12 months. They can enter into a cohabitation agreement if they want to, but obviously, um, basically what it means, that there's no legal form of, being together. It's just based on the timing that they've been together. All right. Now, what would happen regarding spousal support? So obviously in marriage, there's a right of spousal support. If they get divorced, the one that was dependent to the other will be receiving spousal support. But in common law, it's a might. They may have the right of spousal support. It's not mandatory. It depends on what the court will decide. Okay, that's the first thing. Second, let's talk about property division. So again, in marriage, there's a right of property division between the family property, but in common law, there's no such a thing as a family property, and they do not have the right of property division. Now, this is different than, a common law partner. They purchase a home together, right? That is considered their own, like both of their properties. It's a property for both of them. But let's say if the husband, like the guy, had a home and they were both living in it, and now they decided to separate, right? That's not going to be any property division. But if they purchase it after they were together and they're both contributing into it, obviously that is something that would be, divided as well. Okay, so just don't mix these two together. What we're talking about is specifically uh, family property that does not exist when it is a common law. All right, let's go into some questions. Sarah and Jean Paul are divorced and have had an acrimonious, basically it means a bad relationship, ever since. Sarah is often late with child and spousal support payments and is 6 months behind in payments when she is killed in a car crash. Jean Paul is suing her estate for the support that he is owed. What course of action will the insurance company take with regards to payment of the insurance benefits from Sarah's life insurance policy, which has her estate as the beneficiary? All right. So Sarah had a life insurance. The beneficiary of the life insurance was her estate. She dies, and she was, basically behind, 6 months behind in child and spousal support payments. Obviously, what happens in the estate is exactly that. Creditors come and they will, um, be paying it out from there because it's going to be a creditor, right? So the answer is the insurance company will pay the benefits directly to the estate. That's what the insurance company does. The insurance company does not make a decision to who to pay. They just pay it to whoever the beneficiary is on the application. All right. And then the court will decide. So basically, the probate court will decide who receives the benefits. And I just want to put in another case here. If there's any questions or doubts about who is receiving the money, let's say somebody disputes and say, hey, I was the beneficiary, not person X or Y. In that case, if the insurance company is not sure exactly who to pay to, they will pay the court, right? And then the court is going to make a decision. So the insurance company does not make decisions on who gets the money. It's whatever that is in the application and in the policy. All right. And in this case, it was this. But something else that's really important here. Let's say Tom was first married to Mary. All right. And then they got divorced. Tom is paying spousal support to Mary. And then Tom remarries to, I don't know, who should be the name? To Sandra. All right. And changes the beneficiary to Sandra. So Tom had a life insurance policy when she was married to, when he was married to Mary. Mary was the beneficiary. Now that they got divorced, obviously doesn't want Mary to get any money. Changes the beneficiary to his new wife, who is Sandra. But when Sandra receives the death benefit, they will see some deduction out of it. Why? Because Tom was behind in, you know, Mary's spousal support. This is one of the only cases that the death benefit might be seized, is when you are behind in child or spousal support. So Mary can go dispute in the court, and the courts can order that if the death benefit that Tom had was the only asset remaining, they can take that money out of that death benefit. All right, that's really important. Let's go into another question. Tai Hyun gets transferred from his company in Canada to work on a long-term project in London. He owns a property in Canada, which he plans to sell soon. Therefore, he prepares a legal document to appoint his brother Jay to deal with the sale of the property on Tai Hyun's behalf when he is away. Which of the following terms best describes the legal document? So see, it is only a legal document appointed to the brother that they can only deal on the sale of the property, nothing else. So obviously, it is a power of attorney. All right, let's go into some interesting topics. Provincial and territory legislation. So what is that? It is about some of these legislations and organizations that we need to know about. The most important one, or one of the most important ones, is PIPEDA. PIPEDA stands for Personal Information Protection and Electronic Documents Act. So whenever you have a question regarding personal information of the clients, the answer is PIPEDA. So PIPEDA governs how businesses collect, use, or disclose personal information during the course of their business activities. So marketing consents, release of personal information, all of that, it goes here in terms of PIPEDA. So one of the most common questions that comes up is here that maybe John is a part of a golf community, right? And they go play golf every weekend, and they're all friends. They have a WhatsApp group chat or whatever. Now also he is an insurance agent as well. So John tells his assistant that contact all these people and offer them or suggest or whatever to get an appointment with us. Even though that they are all John's friends and they know each other, John is not allowed to do that without their consent. All right. So as in the terms of business activities, you have to have the consent to call them or to reach out to them or to disclose their information. All right. This is something that's really important. Also, this is regards to where you store your client's information. Also, it's about, let's say there's two people, one is a realtor, the other one is an insurance advisor, and they say, hey, let's, share each other's clients' information. Maybe we can get referrals or we can get business from them. We cannot do that without their consent. Next one is called DNCL. So DNCL is a do not call list. There is basically a phone number list, right? Which is called do not call list. And you can put your number there. When telemarketers or any other company, a business wants to reach out to people to just basically reach out to them for sales and prospecting or leads, you have to make sure that their number is not listed on this DNCL. Okay. So if I have my number registered on the DNCL, nobody is allowed to call me without my consent. If I have given consent that you can reach out to me, that is different. But you can't just call random people and promote your stuff. So you have to make sure that that business is registered to DNCL, has the proper list, and whoever they're calling is their number is not in that list. Okay, that's another important thing. So again, let's go to the previous example. If John wanted to call their golf club, friends, the admin also has to make sure that they are not on the DNCL list. Okay. Anti-spam legislation. This one is specifically regarding emails, right? So it's prohibiting to send spam emails, commercial electronic messages. They all have to have the recipient's consent. All right. So you cannot just send promotional emails to people. There has to be basically a consent, right? And if you don't have the consent and you keep on sending these emails, these promotional emails, it could be a fine. So that's why that we have the unsubscribe button. That's where it's actually being used, the anti-spam legislation. So in the questions, if it's about personal information, the answer is PIPEDA. If it's about calling them, the answer is DNCL. If it's about emails, it is anti-spam legislation. Easy as that. Let's go into FINTRAC. So FINTRAC is the Financial Transactions and Reports Analysis Center of Canada. Basically, whenever we're talking about terrorist financial acts or money laundering, this is where the answer is. You guys know two most important times that we have to report to FINTRAC. One, when there's a transaction of cash of $10,000 or more in 24 hours, right? Or there is a $100,000 transaction and that person is politically exposed. That means either them or one of their close friends or close family members or close relatives are a politician. In that case, if there's a transfer of $100,000 or more happening any sort of way, our job, our duty, our responsibility as an insurance advisor is to report it to FINTRAC. Our job is not to make a decision, either this is money laundering or terrorist financial act. It is our just duty and responsibility to report it to FINTRAC. And you have to do that in 30 days. All right. So this is really important. Let's talk about CISRO. So what is CISRO? CISRO is Canadian Insurance Services Regulatory Organizations. Basically, it's a group that have developed and written down all the standards that we're reading. So if you look into the textbook, what does it say on the top? CISRO. So CISRO has, basically written all these laws, right? And this is really important. Whenever you see the word standard, the answer is CISRO. Easy as that. So whenever it's asking, what is the organization or the group that provided or built or whatever created these standards, obviously the answer is CISRO. If it asks who is the one that's implementing them and mandating them to the provinces and all the regulatories, it is called CCIR. So if you see the word mandate, the answer is CCIR. If you see the word standard, the answer is CISRO. Or even if they say, what is the organization similar to CISRO, which is mandating those standards, the answer is CCIR. Okay, this is how you can answer them quite easily. And last one, if there's any questions regarding complaints, answer is OLHI, the Ombuds Service for Life and Health Insurance. It's a national independent complaint resolution organization providing clients with assistance to their inquiries and complaints pertaining to Canadian life and health insurance products. All right. So this is really important. If you have any questions that is talking about complaints, this is where people can go and they can submit their, dispute or complaints, which is OLHI. So again, PIPEDA, personal information, DNCL, anything regarding calling, anti-spam legislation, anything commercial, electronic, stuff like that. FINTRAC is about money laundering. CISRO is about the standards, and CCR is about mandating those standards, and OLHI is compliance. That's how easy you can answer these questions. Let's talk about Assurus. So what is Assurus? Assurus is a non-for-profit organization that protects Canadian policyholders if their life insurance company should fail. So what happens in this case? Let's say company A goes bankrupt, okay? Assurance is going to come in place, right? And they're going to offer the A's clients to, let's say, insurance company B. So the A policyholders are going to be, or the A clients are going to be transferred to company B, and they're going to be the new insurer, all right? In this case, Assurance is not paying anything, policies are valid, nothing is going to change. Let's say A becomes insolvent, and there is no company that would basically want to take over those clients, okay? In that case, Assurance is going to be paying them themselves. All right. So first, Assurance, what they do, they try to find another insurance company to take over those clients. If they can't find any insurance company and the client passes away, let's say if it's a death benefit or critical illness coverage or sick funds, whatever it is, this is how Assurance is going to pay. So for death benefits, they're going to pay 100% up to $1 million or 90% of the promised benefits, whichever is higher. So this is really important. Let's say if someone had $800,000 of death benefit and the company goes insolvent, Assurance is going to pay. Assurance is going to pay the $800,000. If it's $1.5 million, what's going to happen? You're going to look at it, you're going to say, what is 90% of it? So 90% of it is going to be about 900, 450. So it's going to be 1350, right? 1.350. So now which one is higher? Basically $1 million or 90% of the benefit? Obviously, 90% of the benefit is higher than $1 million. So the Assurance is going to pay 1.350. What if it was $1.1 million of death benefit? What is the 90% on this one? 90% of this one is going to be $990,000. So how much is Assurance going to pay? They're going to pay $1 million. Why? Because between $1 million and 90% of the promised benefit, the $1 million is more. So always like if the entire benefit, if the actual benefit, original benefit is less than $1 million, Assurance is going to pay in full. If it's more than $1 million, you just have to calculate what is 90% of it, and then whatever is higher, that is the one that Assurance is going to pay. Same thing with, let's say, critical illness or health expenses, $250,000 or 90%. Monthly incomes, let's say if it's a disability insurance, $5,000 a month or 90% of promised benefits. Let's say it's sick funds, it's cash value of your life insurance or anything like that, $100,000 or 90% of the benefits. Remember, for sick funds, because the promised benefit is your guarantee that you have on your sick fund. So why do I say this? Let's say the person deposited $100,000 in the market and basically had 75% guarantee. All right. And in the market, now the money is $60,000 and the insurance company went insolvent as well. And the person dies. So the guarantee was 75%. What is 75% of 100,000? It's $75,000. Now, the Assurance is going to pay 90% of the $75,000, but whichever is higher compared to the $100,000. So because $75,000 is less than $100,000, you're going to compare $75,000 with the 90% of $75,000, which is obviously lower than $75,000. So Assurance is going to pay the entire $75,000. But let's say if it was, let's say if it was $200,000, right? And it turned out to be $160,000. Now, what is the guarantee? The guarantee is $150,000. So because the market value is already 160, right? They're going to pay 90% of, well, honestly, in this case, they're just going to pay the 160 because it's above the guarantee and it's the market value. But let's say, let's go with another example. Let's say the market value is not, it's $100,000. So now the guarantee is $150,000, right? What is 90% of $150,000? It is 900 there. It is 945,000, 94,500, right? So is that right? 8,000. No, no, sorry, it's 90 plus 45, it's $135,000. Sorry. So this is the 90%, right? So right now, between the 135,000 and the 100,000, which one is higher? The 135,000. So assurance is going to be 135,000. So if the guarantee is less than $100,000, assurance will just pay whatever the guarantee of that seg fund was. If the guarantee is more than $100,000, then you calculate the 90% of the guarantee, so 90% of the 150 in this scenario, and then whichever is higher between that one and the $100,000 would be paid. All right. So I hope that I was able to explain this. But let's say if the market value is more than the 75% guarantee, obviously the insurance company is just going to pay that. So this is what assurance is. Now, I believe this is the last part that we need to talk about, right? Nothing more that we need to cover. So refraining from unfair or deceptive practices. So first of all, acting in good faith has three parts: duty of care, integrity, and competence. You can study what they exactly mean if you don't know what it means, but obviously this is really important. So if they ask which one is not part of acting in good faith, obviously the choice that is not one of these three would be the answer. Okay, we're not going to go into much into it, but let's talk about some of the deceptive or unfair practices that advisors might make, and because there's going to be some questions regarding it for sure. Okay. So first, tied selling, making the purchase of one product conditional to purchasing another product. All right. So what does that mean? That means that a client comes to me, right? And they say, I will only give you this life insurance if you purchase a TFSA with me as well. So I'm only going to, so I'm tying these two products together. This is tied selling, and we are not allowed to do this. I will only give you this life insurance if you get a critical illness rider on top of it. That's a tied selling as well. Okay. First one. Second, let's say there's an existing client, right? They have life insurance with company A. All right. And then me as an advisor, because I know the client already has insurance, I won't be able to upsell, and I have to, I have to tell them. Well, I don't have to, but I'm unfortunately going to tell them that, hey, give up your product. That product is not good for you, and I'm gonna give you another product so I can get commission on it. If I do that with the same company as company A, it will be called churning. All right. So churning means encouraging a client to give up on a product for another product, even though that they don't need it. If in that case, it is actually beneficial for the client to make this change, that is not churning, right? That's why we have the LIRD form. We talked about it in the understanding insurance video. So churning is only when you are looking at your own benefits as a priority, not the client's benefits. Let's say if the client has a product, it's a shitty product. They're paying $200 a month, the benefits are low, and you actually have a better product for them that they're eligible for, the price is cheaper, and it's going to give you more value. That is not called churning, because you're putting the client's benefits and interests in priority. Now, if I do this for my own benefits, it's called churning. If I do it between another insurance company, so let's say the product that they already had was with insurance company A, and now I'm offering them a product with insurance B. In this case, it's going to be called twisting. All right. So the difference between churning and twisting is that churning is from the same insurer, and twisting is between two different insurers. Premium rebating. This is where an insurance advisor tells a client, let's say a client says, hey, this premium is too much, or maybe I should start in 3 months, I don't have the money right now. And the advisor offers to pay back or pay a portion of the premiums. Say, okay, don't worry. Get this policy. I'll pay you the first two premiums. Don't worry about it. This is called premium rebating, and you're not allowed to do that. Or you tell them, like, purchase this one that's $300 a month. Client is more comfortable with $200 a month. Eventually tell them, look, you know what? I'll pay you that $100 a month, but you get this $300. This is called premium rebating. Trafficking. Trafficking means that you be an intermediary between a policyholder who wishes to sell their policy with a potential buyer. So us as insurance advisors, we are not allowed to find a buyer or a seller for insurance policies. This has to be something between them and not any insurance advisor involved. All right. So we cannot do trafficking. Just like human trafficking is illegal, drug trafficking is illegal. Obviously, insurance policy trafficking is illegal as well. Okay. Inducing to insure. This means that I'm going to a client, or a client is coming to me, and because I want to convince them to purchase an insurance policy or whatever, I'm offering them a gift or a payment. So I will like buy them a really unnecessary gift, which is more than the norm, right? Let's say it's a huge policy. I know that I'm going to make $10,000 out of it. So it's actually worth it right now. I buy them a MacBook, $2,000. If I give them this $2,000 as a gift, or if I buy them a really expensive whiskey, I would say for $400, whatever, because I'm making more money out of the commission and I want to convince them to buy this, it is going to be called inducing to insure. So we are not allowed to offer a gift or a payment or anything to purchase, to convince a client to purchase a policy. All right. So tied selling, churning, twisting, premium rebating, trafficking, and inducing to insure. These are all really important. Let's go to the next one. Next one is called fronting. It actually comes in the exams a lot, right? And usually comes in this subject that there's an insurance advisor. They are really busy. They have a lot of clients, right? So the assistant takes care of the application and then the advisor just signs it without seeing the client. It might even be an existing client. They're just renewing their policies. Maybe the clients are happy because they're not waiting in line and their stuff is being done much sooner. It is still illegal to do that. All right. So it is not right. Fronting is not right. Insurance advisor has to be the one soliciting business, has to be one that is submitting the policy to the insurer, right? And we cannot have anyone else's name, basically to take care of that. So this is really important. All right. Next one, misrepresentation. All right. Misrepresentation means that you, make or issue or circulate any, illustration or sales material to make any statement that is false, misleading, or deceptive. So, obviously you shouldn't be telling the client that, hey, this illustration is guaranteed. You shouldn't be showing them some documents or terms and conditions that is not from the insurance company. So all of these are really important, all right? Please do not do those. And also forgery, which means that you make a false document if that it's the wrong thing to do and it's false and it's misleading. Let's say if the insurance company requires bank statements and you provide false documents, that is called forgery and it is illegal. If you do any of these, honestly, your license is going to be suspended. All right. So this is another thing that's really important. Please don't do any of these. All right. This is a really important career for you and you don't want to lose your license just for one policy or one sale. Let's quickly go into some questions. So Ronnie asks his advisor, Selma, which of these organizations is responsible for developing consistent standards of qualifications and practice of insurance across all provinces of Canada? What did we say? If you see the word standard, the answer is CISRO. Easy as that. Let's go to the next one. Tina, a new client, asked her agent about regulation in the insurance industry. Tina wants to know whether this is if there is an association like CISRO. So we said like CISRO that promotes an efficient and effective regulatory system in Canada that serves the public interest. Which one is it? It is called CCIR. So we said it, that if you see the word mandatory or they say that it's something similar to CISRO, the answer is going to be CCIR. Let's go to the next one. Fred meets with his client, Ian, to sell him a life insurance policy. Since Ian is reluctant to sign, Fred offers to pay the premiums for the first 3 months. Which deceptive sales practice is that? Obviously, it is called premium rebating. Let's do a review here. What is trafficking? Being an intermediary between somebody that wants to buy and sell life insurance policies. Inducing to insure is when you give a gift to convince them to purchase, and tied selling is when you tell them that, hey, you can only get this policy if you get this other policy or other product with me as well. All right. Last question. Sheena is an insurance agent and Joy is her assistant. Sheena provides Joy with a list of her existing clients and asks her to call them and provide information about a new product that is available in the market. Sheena has registered and subscribed to the National Do Not Call list. What is Joy expected to do in this situation? So these are existing clients, but it's not about their existing policy. What is it about? It's about a new product. So they have to have consent. If they don't have consent, they're not allowed to call them or send them information, right? So they cannot call anyone that is on the list. Okay, they can only be calling those whose number is not registered with the DNCL. So let's do a small review over here as well. DNCL, what is it? DNCL is for the calls. Anti-spam legislation is for electronic messages. FinTrack was for money laundering. Pipedo was for personal information. Just doing a review here. Let's go into this question. Less than 2 years ago, Carlton purchased a life insurance policy with a face amount of $1.5 million. Last week, the insurer filed for bankruptcy. Carlton calls the insurance agent who sold him the policy and asks what will happen. So obviously the answer is going to be Assurance will protect 90%. Why is it 90%? Because it's $1.5 million. Life insurance, we said it's up to $1 million, right? Or 90% of the benefit amount. We'll have to see which one is higher. 90% of $1.5 million is obviously higher than $1 million. So the answer is going to be D. All right, wonderful. in about an hour, we finished the ethics course and all the important parts of this module. You guys should be okay to pass the exam. Obviously, this was 80% of the information. Whatever was important, different case studies, we had it together. We made sure that you guys understood everything. If there's any questions, we can, drop your questions down in the comment sections. But I think you guys are ready. Just need to do a couple of mock tests and you're good to go. Wonderful. Hope to see you guys later in another video. Thank you.